Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. Markets getting a boost here following big tech earnings. Amazon continuing to rip. We'll have more on that. But right now, there's under an hour to go until the closing bell, and stocks are higher. Let's take a look at the popular averages. Dow's up about 150 points. S&P 500, your broad gauge, is up about 0.6%. And your tech-heavy NASDAQ up about 1%. Let's welcome in now senior reporter Inez Ferre. Inez, break down what you're seeing so far in today's trade.
Yeah, Josh, it looks like we are going to be closing in the green for all three major averages with half an hour left of trading, as you just mentioned. I'm going to pull up a 1 month chart so you can see that we likely will be in the green for all three major averages as we close out the month of October. Taking a look at where we're at with the 10-year Treasury yield, we had been noting that it's been up slightly at 4.1% for that 10-year. The U.S. dollar going a bit higher, and then looking at a Bitcoin that has been rebounding today, up more than 2%. Looking under the hood where we're at with equities, as you mentioned, Josh, Amazon up more than 10% after a strong quarterly report. Also, Tesla today rebounding up more than 3%. The rest of the Mag 7, some little movement except for Meta that is down for now a second day in a row, down more than 2% for Meta. And just looking at the sector action, consumer discretionary, energy, those are the sectors that have been leading today, Josh.
All right. Thank you, Inez. Appreciate it. Amazon, stock of the day on Wall Street. Shares are soaring on the back of third quarter results, which beat estimates across the board. The AI boom fueling massive growth in the company's cloud business, AWS. Joining me now, we got Ron Josie, Citi senior analyst. Ron, great to see you as always. So Amazon reports, Ron, that stock is ripping higher. You know, heading into this print, Ron, there were, questions, there were concerns in some quarters about AWS. I'm curious whether you think this report, Ron, does it put those concerns to bed?
It certainly helps. That's for sure, Josh. Thanks for having me. I mean, look, that was the debate going into the quarter. Not retail, not necessarily health of the consumer, not profitability. It was AWS. How much are they losing share? Notwithstanding, are they gaining share? And what is their strategy in generative AI? And lo and behold, a few days later, we get more insights. And I think the most important thing from this quarter was the fact that Amazon now has the power in terms of infrastructure with 3.8 gigawatts being built over the last 12 months to support the demand they're seeing from an AI and core cloud perspective. So this was, I would say this was a quarter that wasn't even a down payment. It was, we've got the power. Now we can actually move forward and see continued demand. And there's a lot of different, what looks like shoots that we can follow that should drive continued growth going forward.
I also want to get your take on this North American retail business, up 11%, sure. Ron. What are you telling clients, growth and margins could look like ahead?
Yeah, I mean, it's a great question because one of the highest margin businesses that Amazon breaks out is AWS, and for quite a time that's been the power generator of margins. But now with retail continuing to deliver double-digit growth, becoming more of an essentials to you and I, to everybody. So we like to call that wallet share gains, as it's so easy just to buy anything and have it delivered within the next hour or 2 days, whatever it is. That's becoming more profitable. And as that business becomes more profitable, I think Amazon could actually generate significant amounts of operating income and therefore cash flow, really to fuel their investments, of course, in CapEx and to make sure they have the power to supply all the demand. But frankly, to be a much more profitable company, and retail is at the tip of the spear there. We're starting to see more efficiencies. We're starting to see continued demand, and I think that continues.
I also like, Ron, you call that Rufus here. Now, that is Amazon's AI shopping assistant. You say a $10 billion plus incremental opportunity. Walk us through that, Ron.
Yeah, it's crazy. I mean, we have been talking about how consumers on the internet or consumer behavior on the internet is adopting and changing, right? So search engines are now more answer engines. How we utilize apps on the web today is going to be very different than how we do it in the future. Commerce is wrapped up in that conversation as well, and agentic commerce specifically, just because it is increasingly easier just to ask an agent, hey, look for the shoes that I've been looking for and alert me or buy it for me when it reaches a certain price. Rufus is able to do a lot of that for you today. And the better part of what Amazon is doing here with Rufus is they're leveraging all of their SKUs, their billion plus SKUs, their reviews, and what they know about us to deliver, or at least highlight to us, to surface to us some of the goods that we're looking for. And so the company yesterday talked about an incremental $10 billion from Rufus. Rufus just started not too long ago, but we're seeing greater engagement, increasing interaction, and frankly conversion rates, and that's really the key for most commerce businesses, is driving that conversion rates. And I'd say Amazon is on the cusp of really starting off on the right foot with this agentic commerce strategy here.
Ron, I'm going to get you out of here on this. I know you're a believer in the stock, but what are the risks we need to think about over the next 12 months? What do you tell clients? Is it cloud competition? Is it macro risks? What are they?
Yeah, I mean, it's a bunch of everything, frankly. First and foremost, if we just look at the retail business itself, it's the health of the consumer. And so we really want to see a good, healthy holiday shopping event here coming up soon and have that continue going forward. And that's the retail side. Though I will say, offsetting that is just greater efficiencies in retail business, but the risk here is the consumer. Competition, you do know there's Walmart involved and others in e-commerce, but frankly, it's an Amazon's ballpark. And then also from an AWS perspective, and we're seeing the competition grow, right? A few years ago, it was AWS was the cloud provider. Now Azure's doing better. Certainly Google's GCP is doing better. And frankly, AI is helping to leapfrog a lot of that. So we're not out of the woods yet with AWS, but goodness gracious, with the 3.8 gigawatts of power they turned on and then 20+% growth, I think the future is certainly brighter today than it was a quarter ago.
Ron, always great to see you. Have a great weekend.
Thank you, Josh.
Well, Amazon helping lift the NASDAQ, and the major averages now higher across the board. Join me at Barbara Duran, BD8 Capital Partners CEO and CIO. Barbara, always great to see you, especially on set. Let me start here. As investors, Barbara, we don't have all the government data we would like right now. Neither do our central bankers, but we do have earnings. We do have commentary from CEOs and CFOs, right? The folks who are actually running companies. Big picture, what do you make of this earnings season? What have you learned?
Yeah, no, it's interesting because we are hearing directly from the companies. We also have all sorts of non-official data from like the Blackstones of the world who invest in hundreds of companies. And so they're getting a good feel for what's happening in the job market, which has been the big issue. But if you look at what's happened as of the end of last week, we'll get the data in another day or so for this week, but some 87% of stocks were beating on earnings, 83% beating on revenues, and that's far above the 5 and 10-year averages. And this marks the 9th consecutive quarter, of increasing earnings. Right now, in the aggregate, it looks like 9.3%, in the aggregate, not counting all the AI names. And also margins are strong at 12.8%, which is above historical averages. The key thing, though, is guidance. And the guidance from companies looks good. I mean, you're seeing it from the entertainment, travel. You saw Booking.com yesterday. Amex has reported. Visa's been weighing in. They're not seeing any cutback in spending. There is, of course, it's the higher end consumer that's spending, not the lower income as much. They're getting a little more stressed, in this environment. But when you think about the amount of wealth that's been created since 2019, it's something like 40 to 50 trillion of household wealth. And that money's out there. And right now there's full employment. It's pretty much labor is slowing, but firing, there's been some layoffs announced this last week or two, UPS, Amazon. We've got to keep an eye on that if that's one-off or that's beginning of a trend. But right now things look good.
How do you feel about mega AI trading trend? After this week, we heard from a lot of big tech names.
Yeah, there's been, obviously, that last year there was a concern, particularly with NVIDIA. They kept blowing away the numbers, and the fear was this is going to be short term. It'll be over in 6 to 9 months. So I think there's been so much data coming in, and a lot the last month or so, that's reaffirming the AI trade is alive and well, right? And even NVIDIA this week, earlier in the week, said that for the first time they gave an 18-month forward forecast of saying this looks sustainable. 500 billion in AI chip sales. So I don't think it's overdone. People are concerned that, they're all investing in each other and it's this
circular web, yep.
Yeah, but I don't buy it because they're using free cash flow and they are creating value. And even, again, Jensen Huang talked about the virtuous circle. We invest more, it makes the AI more sophisticated, more people can use it, it drives down the price. And even, what Ron just talked about, Amazon, it's helping people shop. e-commerce continues to penetrate. It's only about 20% total retail, but those are the kind of things that are getting more people shopping, and Amazon will continue to gain share in that regard. So I think there's a lot more to go. We are still in the early innings, and it's right now it's the AI chips, it's data centers, and it's energy needs, but it's going to broaden out into other applications, other companies that we have not even, come public yet, that we don't know about, that we're going to be hearing about and using. So it's the beginning of something very big and I think very long lasting.
So it's a lot of good news, Barbara. I guess my question is, how much of that good news do you think is now already priced in? You look at valuations, how stretched are we?
Well, I think that's a very good question. Certainly the market is about 23 times, earnings. And I think at any given moment in time, you are going to see things run ahead like this week. I mean, it was setting up perfectly. I mean, people came in looking forward to the Fed cutting. They were a little bit disappointed about December, maybe not be a sure thing. You had the AI earnings coming from 5 very big and important companies. You had very good news, from Trump on tariffs, with Japan and China calming things down there. And of course the earnings, which are key. So, it all's looking, pretty positive.
Let me get you out of here on this. Quickly, some opportunities. Quality large cap growth names, Uber, Eli Lilly, and CrowdStrike are 3 on your radar. Is there a common theme among those names, Barbara?
Well, the common theme is that they are all innovators and leaders in their field, and they've created, their fields like Uber, both food delivery and ride sharing. That was their thing. Eli Lilly has the weight loss, and they have so many products in development feeding off of that, so all of them. And CrowdStrike, cybersecurity, you've got to be involved in. It would be CrowdStrike or Palo Alto. So it's really looking for those themes where the companies dominate, and it's got long legs in terms of the growth.
Barbara, always great to see you. Appreciate your time in those picks.
Great to see you. Thank you, Josh.
Coming up, Chevron beating Wall Street expectations. We're speaking with the firm's CFO. It's a conversation you don't want to miss. Stick with us. Now time for some of today's trending tickers. We're going to start off here with Walmart. That stock under pressure, but off earlier lows. It's after a judge ruled the Trump administration must fund SNAP benefits during the government shutdown. Millions of Americans are set to lose those benefits starting Saturday. As of now, unclear if the ruling will be enacted in time. And this one, Brooke DePalma, of course, here with me to talk about all this. Brooke, so investors have been watching this because we had these reports about companies, including big names. Walmart were preparing for, I guess, a dip in November sales if the benefits had lapsed because of the shutdown.
Yes, there's a few different factors going into play right now. We did see Walmart shares recover down from about 2%. Now they're down, you can see on your screen, nearly 1%. So Walmart, about 25% of SNAP funds are used at Walmart. Now, other stores that we're looking that potentially could get impacted here were dollar stores like Dollar General, Dollar Tree. Now we're seeing a bit of reprieve here based on this fact that it seems potentially like these SNAP benefits could continue even beyond despite the government shutdown. Then on top of all of this, there were these rumors flying around social media today that on November 1st, which is effectively Saturday, Walmarts would shut down across the country because they were scared of potential looting. And this was really a social media video that really took off today. Can confirm, though, that Walmarts will not be shutting down based on any fear that there could be looting, but definitely a crazy rumor that certainly took off, and that definitely impacted Walmart as well.
Yeah, beyond Walmart, packaged food companies, just reading Kraft Heinz, James Smucker, General Mills, Tyson Foods, could also take a sales hit in November of a couple of percentage points. That's per a Reuters report. All right, turning out to Microsoft and OpenAI. It's a new note from Bernstein digs into one number that caught analysts by surprise. It's a $4.1 billion hit on its OpenAI investment. And based on that stat, Bernstein says it implies the AI giant had a more than $12 billion quarter loss, Brooke.
Yeah, what we heard on the call last night was essentially the executives trying to sort of take a step back and say that, not too fast, too quick. We did have CFO Amy Hood say that the Q1 number was not impacted at all by the new agreement that was put in place. We do know that Microsoft took about a 27.5% stake in OpenAI. And the big question here that has investors really swirling around this is these companies that are essentially not profitable yet, and yet we have this money pouring into OpenAI, and what exactly this will come up to be. And this is something that we've been talking about, this bubble risk. Does this actually come to fruition? When will we see returns? And now earlier this week, we were reporting around OpenAI potentially having a $1 trillion valuation. And so it's pretty significant to see when exactly will Microsoft see a return from this, and now the potential of that major loss during the quarter.
Yeah, it's interesting because Sam Altman has weighed in on these heavy losses in the past.
Right.
And basically said, listen, OpenAI, we're going to invest because the opportunity is that great. And according to Sam, if you got to burn billions,
that's
so
what he said. Yeah, he said whether we burn 500 million a year or 5 billion a year or 50 billion a year, I don't care. I genuinely don't. It's going to be expensive, but it's going to be worth it. And that's what investors seem to be banking on as well.
All right, lastly, shares of Robinhood jumping. The company reports next week. Investors are feeling optimistic. It's likely getting a lift thanks to Coinbase. What's interesting about this one, Robinhood, earnings on deck, that stock is a rocket ship. It's up nearly 300% this year. 300%. Even still, most analysts heading into this print, fans, Brooke, nearly 70% who cover that name say, you know what, it's still a buy right here. Look at that chart.
It's pretty fascinating to see the run-up of this company, especially as it gets into so many different markets here. I mean, credit cards, they have gold, I think. They have crypto. And what we're seeing here is from the CFRA analyst, they did say that their exposure here, that they think Robinhood's democratize finance for all is really winning over this environment. They have been slowly leading up to this momentum ever since that meme trade really has taken off. And now really they say here in the CFRA note that their mission is firing on all cylinders and represents a fundamental challenge to the traditional barriers that have historically excluded everyday people. Of course, retail investors really looking to get on trends here.
Just this week, by the way, analysts at Compass Point raised their target. They went to 16, citing revenue growth from equity transactions, prediction markets, and crypto fees. So they are all over it. Thank you, Brooke. Appreciate it. Chevron beating Wall Street's earnings and revenue estimates as the company achieved record production. My colleague Julie Hyman has more.
Chevron boosted its production by 21% last quarter, helped in part by its acquisition of Hess, which, after a legal fight with Exxon, gave it access to a valuable project in Guyana. Chevron's cash flow from operations beat estimates. And joining me now, the Chief Financial Officer of Chevron, Eimear Bonner. Thank you so much for being here.
Hey, thanks, Julie, for having us. Yeah, it was an absolutely great quarter. So strong across the board, beats on EPS and cash flow and record production from across the Chevron assets. So we're really happy with today's results. And that enabled us to deliver superior returns to shareholders through dividends and buybacks. And we can clearly say that the cash flow inflection that we've talked about for a while is here.
Right. I know that is something that you really have prioritized, that cash generation. How are you balancing that with investment right now?
Yeah, well, the cash generation that we're seeing today are a result of, growth projects that we've had in the portfolio for many years. You mentioned the Hess acquisition at the beginning there. That's obviously a significant contributor in the quarter since we closed in early third quarter and fully integrated by the start of this month. So that adds 500,000 barrels of oil a day. But we've also had growth from other assets in the U.S. Permian had their second quarter at 1 million barrels a day, which was terrific. And we have the Gulf of America. They're ramping up their third project within a series of three. And one of the projects, Ballymore, actually hit nameplate capacity in the quarter. We're seeing growth in our international asset in Kazakhstan. So that started up and ramped up. So a lot of the growth has been laid out many years ago, and it's all coming together this year. And so the investments that we've made, we always look at the long term. We always make investments and think through the cycle. And the results are showing up this quarter, and they speak for themselves.
On the call today, I believe your CEO, Mike Wirth, said that 85% of the business is now upstream. Now, for folks who don't follow this day and night, upstream means exploration and production, getting oil and gas out of the ground. So is that does 85%, is that the right size where you guys are concerned?
Yeah, I mean, the portfolio proportions between upstream and downstream, and Mike talked about this morning, have been very intentional. And then within the upstream, we've also ensured that the portfolio, the asset classes, so think of that as the types of asset, that the asset classes were also rationalized and optimized to be high cash margin assets. And so the upstream today at 85% is very intentional, and it's after a decade of decisions, capital discipline being demonstrated, and that's why we're comfortable with where we are today. The balance of the portfolio includes refining and also chemicals, and both of those segments are very competitive. We like those in our portfolio, and we've got growth underway. In fact, in the chemical side of the business, with 2 cracker projects starting up in the next couple of years. So yeah, we're comfortable with where we are, and we think that our portfolio sets us up to have resiliency through the cycle, high cash margins, and durability well through the end of the decade.
And recognizing that it's difficult to predict where oil and gas prices are going to be, what are you planning for the next year in terms of price?
Yeah, well, we're planning for expecting more of a supply-driven pressure on price. Demand has been incredibly resilient. It is growing, and so we expect that it'll continue to grow. But supply, given that we've got some non-OPEC production that's growing, there's also some unwinds happening, and they'll continue to happen, is our prediction. So we're preparing for some softness. And again, because we make all our investments with the long term in mind, with through cycles in mind, we're prepared for any price environment should we see some pressure in the next couple of years. So we expect there may be some pressure. We've seen prices relatively flat quarter on quarter, but certainly drift into Brent into the high 50s just in the last month. And so we're prepared for that with the investments that we have. We're prepared for that with the capital that we have planned to spend. We came into the year with capital lower than the year before, both on the organic side and the affiliate side. And then we've also got a significant cost reduction program underway that's making good progress and delivering the synergies from the Hess acquisition. So all of those things, coupled with the AA balance sheet, make us feel confident that we're prepared and we can navigate it, even if we were to encounter lower prices over the next couple of years.
Eimear, speaking of sort of navigating the unpredictable, I have to ask you about a sort of developing news situation in Venezuela. Chevron has a license to drill there, of course, that was renewed earlier this year after an interruption. At the same time, we've seen U.S. tensions in Venezuela increase. Airstrikes on boats in Venezuelan waters. President Trump hasn't ruled out targeting land targets as well. So are you confident you'll retain the license there? And what do the tensions there mean for your business and the employees who are based there?
Well, first of all, what I would say is we've got 100 years of history in Venezuela, and our view is our presence has been very constructive for the people of Venezuela and the U.S. We have a limited amount of oil coming from Venezuela to the US. Think of that as about 8 to 10 cargoes a month. And, the cash contribution from those cargoes is really paying debt that we're owed over time. And so that's how to think about the operations and the financials. What I'd say about what's going on in Venezuela, we are always and are compliant with US sanction policy and the laws and regulations. So everything that we're doing is compliant with that. And it goes without saying that the safety of our people working there is our top priority. So, we feel today that, our people are safe, and we are always focused on ensuring that's the case.
Eimear Bonner, Chevron CFO, thank you so much. Really appreciate your time.
Thanks, Julie.
The closing bell is next. Going to be right back. That's closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you to speed on the action from today's trade. Yahoo Finance's Inez Ferre joining us now with the latest market action. Inez.
Josh, we have ended off the highs of the session, but nevertheless, a positive week for the Dow, the S&P 500, and the NASDAQ, and a positive week for all three major averages as well. This is where we've ended with the NASDAQ composite up 0.6%. But if we take a look at a 5-day chart, you'll see it's up more than 2%, and a 1-month chart about almost 5% for the month. The S&P 500, same situation for the month, up more than 2% for the month of October, and the Dow also in green territory. Looking at the Russell 2000, that's also for the month in green territory, as well as for the session today. Also, looking under the hood of where we've ended with the sectors, we saw consumer discretionary really leading the gains today, up more than 0.2%. Energy stocks also were higher, as well as communication stocks as well. Over on the NASDAQ 100, you saw Amazon up more than 10% during the session, ending the session just below the 10% mark, but nevertheless, a huge pop for Amazon after its quarterly results. Also, Tesla bouncing back up more than 3%. And Nvidia had been in green territory earlier in the session and ending just slightly lower. But for a 5-day chart, you will see the major gains that we have seen mostly in the Mag 7s, except for Meta and for Microsoft. But nevertheless, you're looking at Alphabet, Nvidia, Amazon, Apple, and Tesla all in the green for the last 5 days. And for the month, also seeing some green for the month as well. And then just taking a look at where we've ended up with the crypto space, we did see today that crypto was in green territory. The crypto-related stocks today seeing a big jump with Robinhood up more than 6%, Strategy also up more than 5%. But take a look at where we've ended up with crypto today. A lot of green on the screen. It's been a choppy week, though, for crypto. And for the month, we had expected that the crypto bulls had said, look, the month of October is supposed to be a strong month. Well, not this month for Bitcoin, down more than 3% for the month of October. Also, Ethereum down more than 6% for October. So not quite that a strong month for the crypto space, but nevertheless, today we did see a rebound in that space.
All right. Thank you, Inez. Well, stocks closing out the week higher as investors digest a big batch of tech earnings, Wednesday's Fed rate cut, and new developments on the trade front. For more, I want to bring in now Simeon Hyman, global investment strategist at ProShares. Simeon, always good to see you. So wrapping up a big week. Let's start with the big tech earnings, because you saw the reports, Simeon. You were listening to those calls. Tech has been leading this market. Mm-hmm. Would you expect that to continue?
Look, the earnings were very well received, all but one. Everybody knows Meta was the one that wasn't well received. Let's just look at the season so far. We're about 2/3 of the way through earnings season. S&P 500 earnings up year over year about 10%. Tech sector up about 20%. Now, I don't think there's anywhere else we can look to get the equity market rally to sustain, but that's pretty good. That should be enough to keep things going, particularly at this time of year, because we know what folks do towards the end of the year. They want to get those Mag 7 names in the portfolio, in those statements. So when clients and asset managers look them up, they say, oh yeah, that was in there.
Let me ask you, if tech did cool, Simeon, do you look around and say, okay, there's certain sectors that would be well positioned to play catch up?
Look, almost everything else is positioned for catch up. The funny thing that I find these days is that folks will look to other parts of the market and say it's at a discount to the S&P 500. Well, that's tautological, because the tech sector is so expensive that it's pushed up valuations for the S&P 500. So everything on a relative basis looks like it's cheap. So it's good to look a little bit past that to see what's actually cheap relative to its own history. But there are clearly opportunities. Certainly, we like some of the cyclical places where the value sectors and really quality value, like dividend growth stocks that have been left far behind, but there's almost anything that's been left behind in this rally is open to participation, very importantly because quality overall is pretty good. Net debt to EBITDA for the S&P 500 is at 1.5 times. that is all-time low. So we can talk about cockroaches in private credit, but the quality of all the large cap stocks, including the 493, is pretty high. So the opportunity for rotation across the board is a decent one.
I want to switch gears, talk about the Fed, because we got that this week too. Now you got your cut, but then Jay Powell talking about the December cut says, hey, no sure thing. Far from it, I think is what he said. You were listening to that. What did you make of that as an investor?
We like the logic that I call 2-3-4. What is 2-3-4? If we get to inflation of 2%, then Fed funds should be 3 and the 10-year Treasury should be 4. So we can call this the last of the easy Fed cuts because inflation's not at 2, it's at 3. So therefore, Fed funds in a neutral spot would be 4 right now. Hence, this is the last of the easy cuts. And I think that's a lot of what Chair Powell said. The next one's not going to be easy. We're going to have to start to make some progress to 2% to cut meaningfully further, and that's important. But the other takeaway of 2-3-4 is what's already at 4. The 10-year is already at 4. No surprise that it sold off just a little bit. You had 25 bips off Fed funds, and the 10-year yield went up 10 basis points this week because we're not all the way down to 2% inflation.
Well, let me ask you, if you were spinning ahead in December, and let's say you did get a pause, I'm curious how you think the stock market would react to that.
So I don't think that that's much of a headwind for the equity markets, nor would I suggest that a cut is much of a tailwind because the long end is likely to be stable. Multiples for at least large cap stocks are more driven by the longer end of the curve, which is probably going to be range bound for the logic of 2-3-4. Now, you can still get a little bit of a benefit to small cap stocks in emerging markets, which have more debts at shorter term maturities. So there you can see a little bit sensitivity to whether the Fed cuts or doesn't cut.
What about those, there were folks on this very show, Simeon, who weren't so sure they should be cutting. Their point being GDP is hanging in there, unemployment's low, the stock market's working, not typically an environment you'd be cutting into.
No, that's exactly right.
Yeah.
In other words, we are probably around neutral right now if inflation is at 3%. And if the risks of the employment market and inflation are roughly balanced, you should stay here until inflation gets down. Now, one of the important things, if you were listening to Powell's comments, was he's actually in the camp that we're closer to 2 than people think. He suggested that their approximation in the absence of all the data we have is actually more like 2.8%. And they're still very convinced, we heard this years ago from the post-COVID context, but very much in the context that any tariff impact would be transitory.
I want to get you this. We talked earnings, we talked Fed. We also got to talk trade because Trump and Xi meet this week. Is the first, face-to-face meeting in a while for those two. It does seem like tensions are at least de-escalating. How, as investors, should I think about that?
Look, it's a darn good thing that it's de-escalating. But if we think about the impacts of tariffs, let's hope that Chair Powell is right that the impact to inflation is transitory. Let's also hope that the impact to GDP is transitory. You have to go back to your first semester of economics. It's just the supply and demand diagram. If prices go, if a tariff would simply be roughly half borne by consumers and half by producers because demand is elastic. Demand will go down a little bit and then prices will go kind of part way down. Simple stuff. But that extra little piece is important. Demand would go down slightly. In other words, there would be a small nick of GDP if tariffs stay high. So, for those of us who are not only generally, free traders, again, nothing's really free. We know in the world there's lots of things going on, but the markets will like lower tariffs, but in higher.
Simeon, always great to see you. Thank you, sir.
Thanks so much.
Well, the government shutdown entering its second month, and one of the key issues for Americans, the threat to air travel as air traffic controllers go without pay. Flight delays are rising. Just today, we're nearing 4,000 for flights within or in and out of the U.S. Former Transportation Secretary Pete Buttigieg joined Warrior Money and weighed in on the shutdown.
These are people that a huge chunk of our GDP, not to mention our lives, depend on. Let me tell you the good news, and it's easy to overlook this. Think about what the professionals in aviation safety have achieved in our lifetime. We went, just during the time I was secretary, 4 years with about $4 billion people, billion with a B, stepping onto a plane, the total number of passenger enplanements. Out of that 4 billion, the number of commercial airline crash fatalities was 0. Why? A huge amount of attention to detail. The example that I like to use, just to show you how much detail goes into aviation safety, is if you're sitting on a plane, in certain kind of planes, you might notice that little twisty plastic thing that holds a tray table in place in front of you. It's got sometimes a little notch in it so that you can hang your jacket, which is nice to have if you're traveling, you don't want to get your jacket wrinkled. If you happen to be sitting in an exit row, that little notch is not there because that jacket could add a fraction of a second per passenger to an evacuation. And if you add up a fraction of a second across a couple hundred passengers, that means you might not make that mark of, let's say, 90 seconds to get everybody off the plane. So it's just one example of the level of seriousness that the men and women who are working in the FAA, whether they're in air traffic control or aviation safety, engaging the industry, which itself employs a lot of veterans who learn these habits of attention to detail.
So be sure to catch that interview on Monday at 3 p.m. And always check out new episodes of Warrior Money on Mondays wherever you get your podcasts. Coming up, Coinbase earnings top estimates. We're speaking with the CFO when we return. Stick with us. Crypto exchange Coinbase beat Wall Street estimates and trading volumes surged. My colleague Brian Sozzi sat down with Coinbase's CFO to learn more about how regulatory conditions have helped and what's in store for the future.
Regulatory clarity has been a huge tailwind that has benefited us all year. That has been one, but it's also product innovation. The technology is there, the customers are now ready. And so it's all coming together where we're really seeing companies now emerge with products, and the products are what's winning and driving the growth as well.
The last time I talked to you, it has been a little bit. I don't know where time goes, Alicia, but it has gone very quickly. Last time I talked to you, I thought Coinbase, it's crypto, it's tethered to the price of Bitcoin, but you've made, I think, a pivot, and you want to become what you call the everything exchange. And right out of the block on the shareholder letter for this, you talk about payments. What is your plan of attack for payments in 2026?
Well, I want to zoom out and talk about the Everything Exchange. The Everything Exchange absolutely is the vision, and Brian set forth a great picture last quarter where we really want to bring more and more assets on chain and trade them side by side. So trading is the vision of the Everything Exchange. But you are right, in addition to trading, we also want to be a payments platform. And payments, we think, are the next big use case in crypto. So we have live APIs. They're live on Shopify, and they're live on Coinbase Business as of the third quarter. It's early days, but we're really excited about what we have as now a vertical stack to enable fast, cheap global payments. So we have Base, which is our digital rail, where we are offering speed and low cost. So we are in millisecond global payment rail. We then have USDC as a stable coin and others that we offer on top of Base. Plus now the addition of these payments APIs, we really think that we have created the foundational elements to open up the growth of payments. So again, early days, but the pieces are there and we're excited to then drive value through customers. We opened up a new partnership this week with Citibank that we announced that Citi will now do pay-in and payouts on USDC through the Coinbase platform. So as we add partnerships, we are the platform of choice, and we think that this will start to drive the ecosystem of payments that will see growth and adoption.
Alicia, a recent JP Morgan research report caught my attention. They're calling out that Coinbase is considering a Base token could be a $12 billion to $34 billion opportunity. What is a Base token, and do those numbers sound right to you?
Well, what I want to share is that it is early days of us exploring a Base token. And because we are very committed to building out in the open, we are sharing with the community, we're sharing with our developers, with regulators, with experts, and learning from them about what a token could look like here. So too early to talk about it here, Brian. I have no idea if we will do this, when we will do this, or how this could be valued and what the value is. But it's something we're taking very seriously, as we want to drive value to the overall Base network and the ecosystem.
As you look into next year, Alicia, what's the next big unlock in terms of regulation? We had so much favorable pro-crypto growth industry regulation this year. Is there another big driver next year?
Well, we're hoping it's this year. So the Clarity Act is the next key piece of infrastructure or regulatory approvals that we need to move forward. And this, we are seeing real leadership on both sides, Democrats, Republicans. We're actively engaged here to try and bring this to the floor for a vote. And this will then help us with the taxonomy of the ecosystem. This will help bring the market structure rules that help unlock security tokens and the tokenization of other assets that we've long hoped for.
Well, Berkshire Hathaway reporting third quarter earnings on Saturday. Our next guest downgraded that stock to underperform ahead of that report, warning that too many of Berkshire's businesses, from Geico to its railroad and energy units, are losing momentum. For more, we're bringing in Meyer Shields, Managing Director and P&C Insurance Analyst at KBW. Meyer, it's good to see you. So you downgrade Berkshire, Meyer. You go to the equivalent of a sell here. That's going to get some attention. It sounds like you say here, you told clients, Meyer, we expect several of Berkshire's businesses to experience declining revenues and or margins in coming quarters. So walk us through that, Meyer. What are you seeing?
Okay, so let me take them one at a time, and thanks so much for having me on. We'll start with Geico, kind of the flagship insurance entity there. Geico has been generating phenomenal profitability, and as a result, in pursuit of growth, it is dampening its rate increases, which means that claim cost inflation, even at normal levels, is likely to erode some of that profitability. And we're also seeing something of an increased propensity of people to file claims. And that's probably related. In other words, when insurance rates were rising, I think people were worried, if I file a claim, I'll get another increase. Well, now they're not getting increases, so there's more comfort filing claims, and that too erodes profitability. When we move to the catastrophe reinsurance business, Berkshire's participation in this market really does move in tandem with pricing. They're very disciplined and they're expensive. And as pricing for that particular product deteriorates in the marketplace, we expect Berkshire to write less of that premium and therefore to generate less of the expected profitability. A third issue would be investment income. Besides the equity portfolio, for which Berkshire is really well known, there's a huge amount of cash, equivalents, short-term treasuries. And when short-term interest rates come down, then the investment yield on that portfolio goes down. And then finally, I'll throw in the railroads. When we look at the weekly carload data that Burlington Northern puts out, we have seen that trail down in recent weeks on a year-over-year basis. Some of that seems to be dampened trade with China, but either way, when we actually look at those factors that are going to drive earnings in the third quarter and probably beyond, a lot of things do seem to be moving in the wrong direction.
And I thought, Mayor, it was also interesting. You pointed out the impact here of the One Big Beautiful Bill. Explain that for us.
Okay, I'll do my best. Berkshire Hathaway has generated a significant amount of bottom line profitability from tax credits associated with alternative energy. Nothing wrong with that. That's absolutely the rules. We estimate that it's been about 6% of total quarterly earnings over the recent past. The One Big Beautiful Bill accelerates the phase out of a lot of those tax credits, which means that over time, the tax credits that would be generated from new investments in alternative energy are going to go away. And when we see that happen, and I should emphasize that's not a third quarter issue, when that happens, we think investors will attach a lower multiple to the earnings that are currently being generated if that source of earnings seems to have a finite lifespan. In other words, if those tax credits are going away, you get some credit for it, but not the same multiple that we would apply to it if those earnings were sustainable.
So you go to the equivalent of a sell, and you make a convincing case, Mayor. If clients asked you, though, okay, you laid out your case, but how could you be wrong? Where's the upside risk in this thesis? What did you tell them?
So I would say there are a couple of things. First of all, we could have a resolution of trade issues with China fairly soon, in which case that could recover. And if Geico is successful in growing its policy counts faster than we think it will, and that growth would be as a consequence of more competitive pricing, that would go a long ways towards offsetting the pricing, or so the profit pressure from the rate cuts that they've been doing. Geico's growth up until very recently had been very, very negative. It does look like it's back in fighting form. If they actually grow faster than we think, that's another source of not just short-term profits, but probably longer-term profitability as well.
Warren Buffett, Mayor, of course, he does plan to step down as CEO at year end, hand the reins to Greg Abel. But just to be clear, the downgraded sounds like it doesn't have anything to do with that.
The downgrade doesn't have much to do with that because it's fundamentally just the earnings side. One concern that we highlight in the context of Warren Buffett stepping back is that there is an enormous amount of investor confidence in Warren Buffett, and obviously that's been deserved. And we think that, unfortunately, the extent, the quality of the disclosures that we get from Berkshire Hathaway are somewhat inadequate. Now, if Warren Buffett is there for the foreseeable future, that's great. You can rely on that. If he's not, then I think there's going to be some concern about the fact that people know less about the company than I think they're comfortable with when they don't have this once-in-a-universe investment guru to rely on in support of the company's operations and quality.
Greatest value investor of all time. Quickly, I just look at this stock, Mayor. It has lagged the market this year. I'm curious what you think explains that. Do you think that in part that is Buffett stepping down there?
We really do. When you look at where its underperformance has emerged, it's most strongly underperformed over the last 6 months, which really captures that what we call surprise announcement at the end of the annual meeting that he was going to be moving backward. It happens to be that property casualty insurance has also been really weak. And while that's not the entirety of Berkshire Hathaway, it plays a role. But we do think that the growing recognition that he's stepping back and therefore we'll call it Buffett halo is fading, has played a role in the underperformance in the shares in recent months.
Mayor, great to have you on the show today. Thank you so much. Appreciate it.
Thank you.
Time now for What to Watch. SNAP benefits are set to expire on Saturday. This is coming as a federal judge on Friday ordered the Trump administration to keep paying out SNAP benefits just one day before those food stamps were set to stop for millions of Americans. Open enrollment for 2026 health coverage kicking off Saturday and running through January 15th. Middle-income households could feel the pinch this year. Enhanced subsidies are expiring, meaning higher premiums for some families. And taking a look at earnings as well, a big batch of reports on deck, including Palantir, AMD, and Robinhood. AMD announced results for the third quarter on Tuesday, and I was expecting AMD's Q3 results to come in line with estimates. The focus now turning to how well it can ramp up its new AI chips in the second half of the year. And moving over to the Federal Reserve, a lot of commentary coming from Fed officials throughout the week, including Dallas Fed President Lori Logan. Logan making comments on Friday saying that the October rate cut was not needed and opposes cutting again in December. Another corporate event to watch, the Tesla shareholder meeting that takes place on Thursday, November 6th. The vote everyone is watching whether shareholders will approve CEO Elon Musk's $1 trillion pay package. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back to Yahoo Finance Monday starting at 7 a.m. Eastern for all of your market coverage leading up to and after the opening bell. Have a great weekend.